Hello, everyone. Welcome to another episode of Personal Finance. In today's episode, we're going to look at one of the advanced topic. You might have heard the term 72T, which is an IRS ruling that allows you to withdraw money from a retirement account. Some of you might wonder, can I withdraw money from a retirement account before I turn 59 and a half? If you have a lot of money in your retirement account, if you want to withdraw it before 59 and a half, typically you will get 10% penalty, and in addition to that you'll also have to pay income tax, assuming the account that you're withdrawing from is a pre-tax account like 401k or a traditional IRA. But there are exceptions to this rule which allows you to withdraw money from your retirement account, not have to pay the 10% penalty. To be precise, there are 13 exceptions. So the list here shows you all 13 of them. The first one listed there is if you turn 59 and a half, then you are free to withdraw money from a retirement account. You don't have to pay the 10% penalty, but obviously if it's a pre-tax account, you will have to pay income tax on whatever amount you're withdrawing. If it's a Roth IRA, obviously you don't have to pay taxes because you have already paid the taxes when the amount was contributed. And there's no 10% penalty either since you are withdrawing after 59 and a half. Before 59 and a half, what can you do? This is especially important and relevant for anyone who wants to retire early. Let's say you want to retire when you reach 50. You have enough money in your retirement account and you want to retire. You don't want to work, right? But you still need to cover your expenses from age 50 until 59 and a half before you can touch your retirement account. To be able to do that, out of all the exception listed, we're going to touch on the one that's called SEPP, substantially equal periodic payments, right? This is one of the exceptions of the 72T rule that allows you to withdraw money from a retirement account. You don't get that 10% penalty, but you would still be taxed on your amount that you withdraw because it's going to be based on whatever income tax bracket you're going to be part of, right? The key thing that you need to be aware is the plan that you work with your CPA or a tax person. It has to be minimum of 5 years or until you turn 15 and a half, whichever is the longest or furthest away. So if you start your withdrawal plan starting 50, you have to continue until 15 and a half. You can't make any changes midway saying that I have enough money, I don't want to withdraw, or you end up withdrawing more, right? Any kind of changes will result into penalty plus interest as well on the amount that you've already withdrawn. So it is key to understand how this works. There are three different ways how we can withdraw money. One is called minimum amount. The other one is through amortization, similar to your mortgage. And the other one is similar to annuity. So these three are outlined in the document that's in the description because that's a little bit advanced. If you're really interested, you need to work with a CPA to see what you want to do. But the key thing here is you can access your retirement account before 15 and a half. You don't have to pay the 10% penalty if you work through the SEPP plan. The second one is called Rule 55, and for public employees, its age is 50, like police officer, paramedics, or certain public employees. For them, the age 50 applies. But for most of us who are not in public service, age 55, Rule 55 allows you, let's say you turn 55 or you will turn 55 this year, you quit your job or you get laid off or you try to decide to stop working, right? In that situation, you can still access your current employer's plan 401k, which is active, and you can start withdrawing from that. You cannot go back to your previous employer's 401k or IRA or anything like that. The rule here is you have to withdraw from your last employers from whom you split. You have to be at the minimum of age 55 in that particular year, higher than age 55. And there is no restrictions on how much you can withdraw as long as you understand that you may have to pay taxes if it's a tax account. Let's say you decided to withdraw from account, right? The contributions will not be taxed, but any gains that you have obtained since you contributed, those would still be taxed. So if you want to do the Rule 55 or SEPP plan, it's better to do from a tax account like 401k or traditional IRA. Roth IRA is better left until you turn 15 and a half, so you don't have to pay any taxes on the contributions, also the growth. The third option listed in those 13 exceptions is education. For some reason, you want to withdraw money for your own education, your spouse or kids' higher education. You are allowed to do that. Again, consult your tax professional CPA to understand how you can do it, what amount you want to withdraw, and make sure there are no tax implications. So these are some of the options that are available. The website where you can get more information is 72tcalc.com, 72tcalc.com. There's also another website, 72tnet.com. So those allow you to run some calculations and the document is 80 page page document that goes into very detailed of all the other exceptions, but bulk of the descriptions or discussions is based on the SEE plan. So take a look at that if you're interested in learning more. Hopefully this information has been helpful. If you have any questions, let me know. Thanks. Bye.